and my good friend Matthew Queen. Welcome to another episode of Profiles and Risk. Have we interviewed you before? I think we
I think
have.
so. A long time ago, probably talking about captive insurance, if I had to guess.
Yeah. Yeah. So we're going to do a slight flip. We're so into we had a event that we hosted a couple weeks ago where we had an entire session on what I called alternative capacity. Captives was part of that. But a big part of the conversation was around MGAs, and that's what we're going to talk about here, because you have one. So, Matthew, start all of these just in case someone doesn't know who you are. Matthew Queen, who are you? What do you do?
I am the chief operating officer for the Tricura Insurance Group. That is my day job. I uh, I frequently post on Twitter about insurance and captive insurance because that's kind of my background. But the way I actually feed my family is I run a managing general agency. We focus on skilled nursing facilities. Um, One of the reasons I wanted to come on here today is kind of talk about what I see in terms of where MGAs are in the market and how exciting they are. Also, let everyone know we are hiring for an underwriter. So I just want to slip that in there. But the interesting thing about an MGA is that power tends to do very well when it's like closest to the thing. Okay, that's like your general rule. So this is why a confederated model for politics tends to do well over time, representative democracy. And I think that we're seeing a manifestation of that rule with the managing general agency. The MGA exists with delegated authority from the carrier. And in the old days, it was much simpler. You know, if you went to purchase a policy from Geico or Allstate, you would pretty much guarantee that somehow or another Geico or Allstate was just like in charge of that whole transaction from soup to nuts. The modern economy is much more dynamic. And in order for carriers to move fast, they need to leverage the talent of people in the market who are just closer to the thing. So in our managing general agency, we focus almost exclusively on skilled nursing facilities, which for those of you who just think of like the way I did, which is just old folks' homes, it's kind of like a generic thing, like Abraham Simpson, like Homer threw his dad into an old folks' home. I thought of that as like a skilled nursing facility. It's not true. In reality, you've got a whole continuum of care. You got independent living, assisted living,
Yeah.
skilled nursing, hospice. We have taken the time to really drill down into an area of the market where we think we have a bit of sophistication. And that sophistication is a function of my background in insurance, the captive insurance things we talked about, a lot of those were in long-term care settings. And then my business partner who has an operational background and he can sit there and speak to nurses in their own language. So as a consequence of my general interest in healthcare and his general interest in insurance, we were able to put together our minds and develop a unique approach to underwriting, which has been successful so far. But where I think carriers like the MGA model is that we can go out there and distribute a whole bunch of premium in an area that they don't need to get up and running in terms of like internal resource allocation. They don't have to learn everything about Centers for Medicare and Medicaid Services, the difference between Medicare and Medicaid, what's Part A, Part B, Medicare, how does therapy relate to the whole thing. That's way outside of what the CEO of Chubb needs to be thinking about. So people like us who live and breathe in that world, we can sit there and literally just walk through a nursing home and say, this is good, that's bad, that's a concern. And we can do a good job without having to spend the kind of resources that these carriers would need to spend to get up and running. This
Yeah.
model is not just for nursing homes though. MGAs are popping up all over the place. You see them in wheels, hired on auto, trucking. We see them in property, and we're starting to see them in cyber insurance, in cryptocurrencies. The MGA model has really arrived, and it is probably the most important thing in the industry for like maybe the past seven to 10 years.
Yeah, well, I have to concur with you because I co-founded two of them as well, right? And I think you really nailed it. And we had this a little bit of a back and forth on Twitter around MGAs. There's a reason why they're growing in number so rapidly is because that structure is really conducive towards getting stuff done. And the carrier model is not necessarily. part of it is because of size. Part of it might be technical debt, legacy debt around the technology, bad culture, or culture that's not conducive to areas like this where the laws could be changing. You have to be on your toes around the underwriting, right? And you can't it's just like I think we're seeing like a convergence of technology with more sophistication around what is risk. How do we define it? How do we measure it? And then how do we manage that stuff? And it seems like the carrier model at one time was really good at this. You have, the FM Globals and the Hartford Steam Boilers. But I think for the prior few decades, they've really struggled with that, Matthew. To me, it's the whole thing. It's not just that underwriting part, but claim service, right? Like the ability to maybe attach a parametric to an indemnity. Like they've lost that ability to have any kind of flexibility. Whereas I think the MGA model, that's why you do it, is to have that flexibility.
I couldn't agree more. The broader thing is that all business is kind of the same. I learned this a long time ago when I purchased a house, fixed it up, and then rented it out. The process of finding the asset, finding the capital, the mortgage company, doing the work, and then finding the renting party uh, showed me that that whole process, they call it BRRRR, buy, renovate, rehab, rent. That model is ubiquitous. You can do the BRRRR model if you're buying nursing homes or if you're buying movie theaters. You can do the exact same thing. So all business is the same. How does that relate to MGAs? Banks are doing the same thing. Banks are doing the exact same thing. You have specialist lenders out there who only operate in the skilled nursing space, for example. And off the top of my head, I can't remember if these are like mezzanine lenders or what the technical term is, but it's identical. So when you purchase insurance from our company, well, you probably don't even realize that, like you being the colloquial person. When the insured purchases insurance, they think they're getting the insurance from their broker. Well, that's the first illusion we have to beat down. Second, you may think it's actually my company, but again, we're just the MGA. We're like the pen for the underwriter, but that's all we have. It's just the pen. And even there, we have a very, very thick box around us. We're not allowed to do whatever we want. We have a very specific authority in the market. And then the carrier is the one who's providing the capital and the capacity to actually issue these insurance policies in at all. Likewise in banks. I just know skilled nursing banking a little bit. You have the big bank. Let's pretend JP Morgan is just a perfect example. They will then work with an intermediary lender who focuses on maybe the skilled nursing space or hospitals or again, movie theaters, or I can't think of anything else off the top of my head. Data centers are hot right now. And they will be given a certain amount of capacity to then distribute to the market through their brokers. Again, it's the exact same thing. The lenders who exist in that second tier lending facility will then sit there and make deals with brokers and sit there and say, I'll work with you and I'll work with you. I won't work with
Yep.
you over here for whatever reason. And they're doing the exact same thing. So once again, we see like the classic thing people say is, banking and insurance are like two sides of the same coin. The MGA model is replicated perfectly on the other side of the equation.
Yeah. In that Twitter thread that we were back and forth, so I just picked up my kids from school. I was waiting in line to pick them up. And that was exactly what I had said in my tweet back. It'll always be tweets, Matthew. I'm sorry. I don't know what other term we're going to use, but still be tweets. That I think what the insurance company brings, their insurance carriers still bring assets to the table, right? They bring capital, they bring the license. That's incredibly valuable, right? They bring the relationships with reinsurance, right? So they are bringing a lot to the table. It's they themselves have struggled to do all of the pieces efficiently. And so, like you said, like with skilled nursing, they probably can't keep up. I saw that, Matthew, on Property Cat. So my first MGA has got to be like 8 years old now. I still don't see anyone underwriting flood the way they're underwriting it, right? Like they're like on their toes, truly understanding what the market's doing, and now transitioning into like risk management around that. And it's just the carrier just has so many things to focus on. You brought up JP Morgan. JP Morgan's got so many things to worry about that they can't, also don't want these opportunities to slip through their fingers. So it's just better for them to outsource to a partner who knows the area better, keep them on their toes, and it becomes a good joint venture working relationship. And that's what I want the audience to understand in the MGA model. It's a joint venture relationship that both parties are bringing specialty areas. For the carrier, it's the capital and the license and maybe the reinsurance contacts. That's what they're bringing to the table. But those are useful tools. You give them in the hands of someone like you, and you're building something.
Yeah, I can't. I want to build on something. If anyone out there is sitting there thinking, "Oh, why don't you just do it all yourself?" Spend 5 minutes in reinsurance markets, and you get back to me on how much you can do yourself.
Yeah.
It is a completely different skill set. And one of the things that I like about this model is that it recognizes that even at the most granular levels, there will be a limit. Okay. And I think car industry does this as well. I mean, General Motors doesn't sell their cars. They have franchise distribute just they have a franchise model where the car dealerships have a deal with General Motors, and sometimes they may have another deal with Ford or Kia or whatever. But the point remains that if GM or Ford could do the whole thing, they would. They're greedy capitalists just like everyone else. So I think it's incumbent upon us, the wisdom that we see from the MGA model is that when you see a very complicated, multifaceted network of fairly ambitious people working together, assume that's the most rational way of doing it. I cannot tell you how many people approach the insurtech crowd in particular. They approach the whole insurance industry as if it's this Gordian knot, and they're going to be Alexander the Great and cut the whole thing. And that's arrogance. The reality is that these weird things that we're doing actually are way more efficient than the other way of doing it because we tried. But not only did we try, but it's also like it's evolutionary, it's organic. I mean, evolution's not just limited to dogs and cats and horses. It's as we run into hurdles and problems and opportunities arise, but we can't get there today. But speed matters. You start to see these models start to arise, and people start to take advantage of that. And that's just kind of the beauty of the market. I think it's a beautiful thing. It's something
Yeah.
that we hope whoever joins us on this journey, we hope to be able to show them that sort of thing.
So let's
My partner and I like insurance quite a bit. It's a fun place. It's far more dynamic than people realize. I think where we've got a little bit of a difference in our firm is that, we're young, like, we haven't been in the market for all that long. So we're at the fun part of the adventure. Like we have like the basic supplies, we have the horse, we have like the guns. Unfortunately, you have to have those. And we understand now, business is a contact sport. And we've grown to a point where like we need to bring somebody on. If I'm being transparent, it's that old adage, like the oldest adage about growing is like good help is hard to find. Like we kind of know like who we want, but we just haven't met that right combination of, I guess, like ignorance and ambition. Because like if you knew how hard it was, you'd never do it in the first place. So like we need someone who's just ignorant enough to think that they can do it. But at the same time, we need like somebody working with us who's like got ambition, like if your job starts at 9 and ends at 5, we have roles for that too, but that's like lower end, that's not where we want. We need someone who understands like we're thrusting into the market. We need to be, doing a handful of things to grow. And that mindset is just kind of hard to find.
Having been an MGA co-founder and I was chief underwriting officer, I did more than just underwriting, right? Like, and I think if people, someone who's potentially coming into a role in an early stage MGA, they're going to learn a ton, right? Like they're going to be exposed to underwriting, they're going to be exposed to distribution, they're going to be exposed to claim, right? This isn't something where like, hey, just send that off to the claims department. I remember in my flood MGA, like when the first few claims started coming in, like we were actually excited, like, oh my God, a claim, like. I wonder how much it's going to be. And I wonder how this is going to work and whether they're going to be satisfied at the end. And so you actually get your hands dirty a little bit around those claims to try to understand that. And I truly wanted to build something where what we learned on the claim side, we could feed back into the underwriting side. So we'd have like a nice flywheel of activity. And so, Matthew, why don't you talk a little bit about skilled nursing and like what an underwriter or someone that's like coming into an early stage MGA, what they're going to be doing on a day-to-day basis. What are they going to be learning? How are they going to be challenged?
You're going to learn how insurance works. I mean, that's the long and short of it. I can't disclose everything about our company here, but like it's more than meets the eye. I have a background in captives, which means that by necessity, I know something about how paper and capacity works. Obviously, my partner and I went through that process to get AM Best rated paper. You will be, doing the basics of looking at loss runs. You got to sit there and calculate, the base premium, apply, the credits and debit, that sort of thing. But also, we don't have the need to underwrite the whole universe. Like everyone else, we've got our capacity limits, and there's a prototype that we're looking for. Once you understand what we're looking for, it actually kind of becomes like a little bit of a hunt. And then to your point earlier, you have to manage distribution. Although we have a broker network, I mean, the expectation is like, hi, meet so and so. This is the next in line. You, Mr. or Mrs. Broker, need to be coordinating with this person. You'll have an opportunity to start to manage those relationships, and we'll expect those relationships to grow. And we want to work with you to show you how to encourage certain types of opportunities to come our way. There's a different carrier for everyone. We've spent a lot of time and energy making a reputation for ourselves with a certain kind of risk within our niche. Okay. We don't even attempt to underwrite the whole universe. We couldn't if we wanted to. So once you learn what that is, you'll start to figure out like, okay, all right, well, I see this. This is a little bit fun working with these brokers, trying to figure out like how you can add value there. But to your point, you will not just be in underwriting. Earlier today, I saw a law I did not like in a state, and I called up the co-founder, and I said, we are not writing anything else in this state. And he said, why? I said, well, we have a claim, and I'm investigating the medical malpractice law in that state a little bit more, and it's one step short of like reverse tort reform. It was negative enough of a procedural issue that I said, you know what? I think we have enough in that state. Maybe we'll consider them on renewal, but there's no gosh darn way I'll ever consider anything more. And he listened to the logic of the law and he said, yeah, that's terrible. Like, who wrote that? And we're just going to quietly, not really do much more in that state. Claims informing underwriting decision was made 5 minutes after learning the new fact. Okay, that's the kind of speed that you have working for an MGA, and that's the kind of stuff that's a lot of fun. If you're in a big AM Best, large institutional carrier, there's a lot of advantage there for sure. But if you identify something that needs to be changed, you have to fill out the form, the change form, and then the change form has to be reviewed by 6 layers of management. And by the time it makes its way up to the chief whatever officer, the opportunity market may have already changed. And that's, I think, dynamic and fun.
Yeah, I think there's we have a talent crisis and folks, I mean, we're struggling to recruit people in, but we're also struggling to retain them as well. And part of it is exactly what you just described. You get someone in, they like underwriting, they see the potential of it, but then they get stuck in a cubicle, right? Kind of thing. And that has been my frustration is even the big name firms, A+ rated carriers, you're not really learning insurance, especially like how to run an entire program. Like what does an entire program need to look like from distribution all the way to reinsurance? How do you connect all those dots? As an underwriter working your way up, it could be a decade plus before you get exposure to a lot of these things and you start to feel and see the pieces together. But at the MGA level, that's your day to day. It is a program. Like you have to understand how all of the dots connect because That's the reason why you're in business, why a carrier is trusting you with the pen to underwrite on their behalf is because you do understand and you can make those kinds of quick decisions. You can change on the fly. You can protect their capital, right? From needlessly, paying a claim, needlessly paying a claim, but needlessly paying a trial attorney, down the road as well. That's been my frustration with the insurance industry is, getting folks in and then making them stale. Right. I think the MGA market offers a really interesting way for folks to get exposure to a whole bunch of stuff around how risk is quantized, how it's distributed, and ultimately how, what the capital structure needs to look like to support that. It's to me, that's very compelling.
I don't love, or not just love. I am dismayed at the cubicle picture that you just painted because it is accurate. And I view underwriting as like one part being like a priest because like you're the one who eventually blesses the risk. Like it's the way it comes in or not, according to the underwriter. And what this does is it puts you in a really weird position of power, also soothsaying. So I really think in the archetypal, like if I had like a deck of cards and I was gonna draw the underwriter, I don't know if it's like a fortune teller or if it's more of a priest. Now the actuaries are clearly fortune tellers. That's their archetype. But the underwriter's role is to coordinate with the actuaries to sit there and worry about the expected loss cost and God willing, bend that thing down. And then also sit there and be a little bit of a gambler, a little bit of a pirate. Okay. Like there's no way to know for sure, even with the best actuarial model supported by, the DeepSeek, whatever the latest AI is. Ultimately, you have to roll the dice, and I think that's exciting. And I think that element of piracy or that element of gambling is just not
No,
there when you're sitting in a cubicle.
no. I think the gambling analogy works really well. I've used that in the past, and I think I think we should be training underwriters to be more like hedge fund managers or hedge fund traders. You look at a show like Billions, right? It's taking information and arbitraging that information. It's taking information and deciding, okay, I'm going to handicap this, and they're willing to pay me this. What's the spread on that? Ooh, that's a good bet. You could still lose, right? Like that's the
That
thing.
was that was that was a very, very insightful comment. And it once again goes like all business is the exact same. I've heard of hedge fund managers who kind of recoil at the idea of being considered gamblers, much like I've heard a lot of underwriters kind of feel like gambling is not what they do. And that's true in the legalistic sense. You are not a gambler, but the element of risk is tied to uncertainty. I mean, my God, the legal concept of fortuity requires some degree of uncertainty. And that uncertainty is where you live and die. Like your entire career depends upon making the right call. And if you don't make the right call, you have to get real tough in claims. And that's ultimately another very fun place to be. And it's an area that if you're in an MGA, you get to not only witness up close, but maybe exert some authority. Because remember, the underwriter may want that account to renew. So if that claim goes south, it's going to be hard to renew that account. So all of a sudden, you have discussions with defense counsel. You start, maybe getting the owner on the phone a little bit earlier, prioritizing getting some data over there, just taking a firmer stance. These things matter. If anyone thinks that lawsuits are not a vibes-based business, then they are fooling themselves. The expected value of a broken hip in a nursing home, I mean, it could range from anything. I mean, is the judge left-handed? That could be an element to worry about. So there's no objectivity on the claim side, which means that negotiations are basically where the whole thing lives and dies. A lot of people thrive in that kind of an environment.
I just posted this morning, Matthew, around that concept specifically is the more I get exposed to the litigation aspect of what plaintiffs do, right? You start to realize like they're underwriting. That's exactly what they're doing. Like a case will come in and they will validate it. They will compute, what are the odds of winning? What's the potential payout there? And I've heard that some of the more sophisticated firms like the Morgans and Morgans are running simulation. Like they're doing what you just described. Like, okay, well, what if we get it into this district? What if we have this judge? What if the judge is left-handed? Like they're examining like how all of these small factors are going to move the expected value of something. And what I wrote in my post was you don't see any mention of merit. Merit doesn't even come into it. It's how much is this worth? Can we get paid? If at some threshold of expected value, it's worth going in, even if we lose, it's still worth it because we have so much tilted in our favor. If we get enough of those, we're going to come out well ahead in the long run. And that's portfolio management on the underwriting side. That's
Yeah.
how I've tried to teach my underwriters is like we want to pay claims. If we're not paying claims, we're vulnerable to losing that business once the property owner figures out, oh, there's no claims here. We don't even have to buy insurance. So we want to pay claims. It's structuring it in such a way where the odds are continuously on our favor. It doesn't mean we're always going to win. Doesn't mean we're not going to have a bad year or two, but it means that if we just execute this strategy, we're going to come out ahead. And it could be incredibly lucrative. We don't know elements of uncertainty.
So, just by my background, I'm just well suited for litigious, knockdown, drag out fight kind of claims. I know nothing of property claims, just to be straight up about it. So take everything I'm saying within the realm of casualty, and even there, really just like wrongful death, grisly, medical malpractice, that kind of area. The value of a claim is directly related to the amount of like points that you can say. Okay. So the plaintiff's attorney will sit there and say, broken hip. Okay. All right. It's broken. Surgery. Okay. That's 2 points right there. Pain and suffering. Okay. All right. That's 3 points right there. Loss of consortium. Okay. That's a separate count. That's 4 points right there. You're missing this medical record. Okay. That's 5 points right there. You see what I'm saying? Like they just
Yeah.
have all these things. And the more points that they have, the higher a value that they put on it. And your job on the other side is to say no for whatever, and you just push back on it. And ultimately, the idea is, basically like in mediation, you get to a place where everyone's certain. Here's the actual stuff. Okay, once I cut through your BS, and once you actually look at the data I've may or may not have gotten to you at the appropriate times, now all of a sudden, now we know what's real. And that's kind of where everyone just kind of sort of like hovers in on a number. That number ultimately is just whatever everyone says it is. I cannot tell you for sure who the market maker is. Is it the defense attorneys settling for too much? Is it the plaintiff's attorneys aggressively demanding everything? In different states, in different scenarios, the answer would be a little bit different. You mentioned something else though, something I've been working on for years and still don't have much of an answer, which is if my point analogy holds water, then you should be able to underwrite the value of a claim. I think we all agree on that. But what is the value of a claim, and can we know all of the factors that go into it? And I've been thinking about that for 2025, over 10 years. Like, what are the factors that go into a claim? And my God, if you could figure that out, if you could have enough data to be able to accurately forecast what the value of a claim is within, let's just say, one standard deviation, that'd be the software nobody else has. What's amazing is nobody can do it. Nobody's been able to do it. The law firms make their money billing by the hour. So they don't have a great incentive to do it, and it's hard. Morgan and Morgan has enough data to get it done. I think they've pushed that ball a little bit further than other people. I don't know enough about their internal mechanics to say if they've solved the equation or not, but they've done some work in this space. But honestly, like something as simple as what we're discussing is absent from most claims departments. The vast majority of claims departments, the overwhelming majority, are focused on, oh God, we got to get the bordereau to the carrier. Like, yes, of course. Like, yes, that is important. Don't screw that up. Also, we should be doing more than just literal paperwork. That is like the base paperwork. And like, oh, we should set reserves on a claim. Yes, you should. You should. And how and where did you come up with those values? Did you run like a little simple average and Westlaw verdicts for the past 5 years in an area that goes to trial like once every 10 years? I'm not impressed with that kind of analysis. So trying to peel back the layers on the onion so you can get to something truly innovative and valuing claims, I view that as green pasture,
Yeah.
something
So
we're very interested in our firm too.
yeah, so I think it's a good way to kind of end the conversation is you're looking to fill a role here and just look at this conversation. Whoever is listening to this that might have an interest, this is what you get exposed to. When you're in an early stage MGA, you get exposed to these sorts of things where you just cannot do that with a similar title at a legacy player. Maybe cubicle's too strong of a word because a lot of people work from home now, so I'm in my home cubicle, right? But it's still the same. It's still there's a bureaucracy there. There's a legacy culture there. Whereas I think in a lot of these MGAs that have formed over the past few years, like you said, I think it was when InsurTech started that you really started to see this convergence in using MGAs as a structure. MGAs became more of like what you would expect a typical startup to behave. Nimble, fast moving, exposed to a lot of stuff. Often, Matthew, chaos. Some people thrive in it, some people melt, but you do get exposed to all of those things. And as we kind of sign off, why don't you describe like technically what the roles are that you're trying to fill?
So the advertised role right now is we have a role open for an underwriter. It would be junior to me and the co-founder. I am, I think, the oldest person in the company. So we are not that old and stodgy. So we are open to people in their, mid to late 20s who are interested in something that's moving rapidly in the PNC or just the I'm sorry, just the casualty space. Um, we've got I think we've got something really special here. I mean, the fact that we were able to hit the market and rapidly be able to grow into a viable organization that now has more needs than it just started with is rare. I've started businesses in the past, they didn't all go so well. This is a really nice one. So we've interviewed a number of people and we just haven't found someone with like vision, like this kind of a conversation. Like, where the hell were you 30 years ago? I could have used you then, or maybe 20 years ago. But you get the point. Like this kind of like mindset where we're both like very interested in the thing. Like insurance is an interesting thing. It functions within our society. You don't have capitalism without insurance. So the point of an investment is to make money, but you have to be able to price out the return on equity. Okay. But without knowing the possibility of risk, how do you know the return on equity? You can't fly to Mars or you can't explore the new world in the age of exploration without some idea of like, okay, what are the odds of this ship actually coming back? That's how insurance manifested. And it has created, again, it's like the oil for the engine of capitalism. If capitalism really depends on geniuses creating new things, that's great. I don't pretend to be that smart. But what I do pretend to do is know my goofball little area of risk and how to look at it. And on occasion, maybe how to reduce it. And then in that delta between the expected value of the risk and what happens when we're done with it, that's where we can make a little bit of money.
Yeah. Okay. Well, um, for those listening out there, you're young and adventurous. Here's a role for you. So always good catching up with you. Next time, I think we'll get back to the conversations around captives.
Anytime.
Okay. Thanks, Matthew.